Hey, my name is Knut Arne Alsaker. I'm the Group CFO of Sampo. And I appreciate that you are clicking on this presentation and want to spend some time to listen to me today. This is, as both you and I know, not an interactive presentation, but I have some excellent colleagues at Sampo Investor Relations that can answer questions you might have to what I am about to talk about. And you find their contact details at sampo.com. I brought some slides with me to support what I'm about to say, and I hope you can see them on your screen. We have been busy over the last 3 years transforming Sampo into a pure-play P&C group. We've done that by selling our Nordea shares and by demerging Mandatum, which now is a separate listed company on the Helsinki Stock Exchange. What we have created is what you see on the bottom end of this slide. A pure-play P&C group. It's a group which mainly consists of Nordic business, about 3/4 of our business, and mainly by retail business, also about 3/4. Then we also have an excellent Nordic commercial business and a market-leading position in Nordic large corporate lines. I'm going to talk about our new financial targets today, but let's see how we performed over the last 3 years while we were busy also transforming Sampo. We set a few targets at our previous Capital Markets Day, which we had in February of 21, where we said we would grow our underwriting profit by mid-single digits, which is somewhere between 3% and 7%, I guess. We overperformed on that target, and this is the mid number on this slide, where we delivered on average an annual growth in our underwriting profit of 15%. So more than double our target. We also set the target for our so-called combined ratio, which is claims and expenses in relation to our premiums of below 86%. And we overperformed also on that target. It's the white boxes you see on the middle of the bar chart. This is a little complex slide, I think, that I brought with me, because it says something about IFRS 4 and IFRS 17. These are accounting principles, and we changed accounting principles. The whole industry changed accounting principles over the last few years. It really doesn't matter. It hasn't changed the way we operate the business. It hasn't changed our pricing strategy. It hasn't changed how we service customers. All these important things that I will talk about over the next few minutes. It's just change in accounting principles. So, delivery on our growth targets and delivery on our margin targets compared to what we talked about 3 years ago. This is a super busy slide, but it talks about what is the basis for our success. And it's 3 pillars or 3 different boxes, but it is really one strategy. So these 3 boxes, they sort of fit together. To the left-hand side on this slide, we talk about customer centricity. And I personally think that should really have been the box in the middle of the slide, because customers is in the middle of all the things we do. The investments that we make to make life for our customers simpler. In the moment when purchasing our products, administrating our products, and not least when we deliver on our promise and customers have claims and need help from us as their insurer. The focus we have on customers have led to 2 important things. It gives us a very high customer satisfaction score, which is very important to us. And it also gives us a high retention rate. And retention rate basically means how many of our customers that stay with us from 1 year to another. And as you can see on that particular point, it's about 90%, just below 90%. Means that 9 out of 10 of our customers stay with us year after year after year. It's an indication of the value we bring to our customers, and it also, of course, gives us a possibility to learn more about our customers, which reduces the risks we take on our balance sheet and make the margin that we have in our business more stable and predictable. To get to these numbers, we make a lot of investments, and we've invested a lot in digital capabilities. We have all our products online, we do claim services online, customer can administrate their products online, and our competent employees, they basically use the same systems as our customers do when purchasing products online. Over the last decade, we have invested more than €1 billion in new technology and digital capabilities. That's a lot of money, and we can do that with our size and scale and use similar solutions across the markets that we are present. So digital capabilities and investments in new technology also a key part of our success and strategy. And then, of course, we need to deliver on our financial targets and have good margins on the products we sell and the risks we take on our balance sheet. All our employees are incentivized. Part of the pay to our employees is linked to the margins that we produce. And we're able to produce our results by having a lot of diversification as well in our business. If we have some bad weather in one market or a large claim or something happen, we have other markets, other products, other segments that does not experience the same situation at the same time. So diversification is also a key part in producing the solid, predictable results that we have delivered over many years. So that was a little bit about our past and our previous financial targets and how we think about what is important to us to deliver good results. We recently had a Capital Markets Day, as I speak, it's just a few days ago, where we announced new financial targets, and you see them on the right-hand side of this slide. One of them is on the margin discipline we need to have in our business with the so-called combined ratio, again, claims and expenses in relation to premiums, of below 85%, which means that it's 1% lower than what I talked about a few minutes ago in terms of the previous targets, which represents the improvements we have made in our business over the last few years. We then also talked about generating more than 4 billion euros of so-called deployable capital, which will generate it both with the profits we expect to make over the next 3 years, as well as capital management actions, which I talk about in a second, which will add to the deployable capital. And then the third target is to generate an operating EPS growth of more than 7%. This is a new way of communicating a target from Sampo. We've had different metrics before. For us, EPS is easy to talk about because it makes it possible for you as an investor to think EPS across industries and not only use various sort of insurance industry specific metrics like combined ratio. But it of course also is an indication of the growth opportunities that we see in our business from the excellent competitive position we go into the next strategic period with. I'll touch more upon this over the next few slides. But starting with this EPS growth, operating EPS growth of above 7%. We had an operating EPS of 2.07 euros, as you see on the left-hand slide of this graph, when we celebrated New Year's Eve of 23. Going forward, we expect our main business, the Nordic business, as you remember, that's sort of between 75 and 80% of our business, to add to our profit growth, also in the mid-single digits, same as the last strategic period. This represents the stable operating environment that we have in the Nordics and the growth opportunities we would see for our different customer segments. I'll touch upon some of them as well in a minute. Where we expect even higher growth is within our UK business. We have an operating ambition, as we call it, to grow, to have a profit growth in our UK business of low double digits, 10 to 15% as this slide says. That adds on a Sampo Group level about 1 to 2% of EPS growth on top of what we generate out of the Nordics. Then, as a cherry on the top on the day-to-day operation, capital management actions will also contribute either through bolt-on acquisitions to the group or through buybacks as a part of spending some of the capital that we will generate out of these capital management actions. Our M&A appetite is unchanged from the last strategic period. It's bolt-ons in the markets where we already are present. And good bolt-on opportunities, they don't come along so often. So if we don't see any such good bolt-on acquisition opportunities, buyback is, of course, an alternative or capital return in terms of buybacks or additional dividend on top of the regular dividend. These are the building blocks for our operating EPS growth target of above 7%. I mentioned growth opportunities a few times already. The sort of pie chart to the right here is a breakout of parts of our total premium volume of 8.5 billion euros. And these 3 or 4 sort of pieces of the pie illustrates some areas where we are particularly positive in terms of growth and have set some operational ambitions to do exactly that, grow these 4 portfolio. Let me start at the bottom, SME, small and medium-sized business. A lot of businesses in our markets are really small businesses, maybe 1 or 2 persons, that buy insurance for their business in a similar way that they buy for themselves, what they own privately, or their family. And these investments that we make in digital capabilities, we've also done for our SME business. Small businesses are now able to have the same digital service, buy products online, maybe at the same time as they buy or renew their products for themselves. And this is widely appreciated by our customers. We see clear growth opportunities because of our abilities and product development in this area to add more than 7.5% over the next 3 years. Then personal insurance, which is, SME 6% over the next 3 years for SME. My apologies. 7.5% though, me thinking about that number is because I'm coming to the personal insurance side of things. Personal insurance, it's a broad range of products, but it's not really insuring stuff. It's insuring you and me, our family, our health, our kids at different stages in life. And there's an increased demand from these type of products as people want additional security for their family, for themselves, on top of what social security systems offer. And of course, social security is not always in some markets a big investment area for the government. That increases people's perception that these products are good to have on top or in addition to what the public offers. We expect these type of products to grow in terms of the total portfolio of 7.5% per year on average over the next 3 years. Private property, easier product to understand. It's property insurance in the retail segment. Good momentum for us also there lately, and it's a product where we are underrepresented compared to, for example, motor insurance in some markets. So we see growth opportunities there as well, with an ambition to grow by more than 5%. UK digital, all our products in the UK are digital and sold in digital channels. And I already mentioned the 10 to 15% growth ambition we have. Our business in the UK, Hastings, have a really strong position in UK digital motor market, and it's about also to grow and establish themselves in the home insurance, digital home insurance market in the UK. So growth will come from both of these products, although no doubt motor is still and will be the main product for Sampo's UK segment. I mentioned digital probably 20 times already, and I'm going to mention it again because it is a main driver of the cost efficiency that we have delivered on continuously over the last 14 years. I talked about that we have invested more than €1 billion in new technology. So you could think that that actually increases the cost base of the group. But what we've been able to do is to fund these investments by being more efficient elsewhere or spend less on old technology. So it hasn't increased the cost ratio for Sampo's main Nordic business. It's continuously reduced it, and we expect it to continuously be reduced also going forward, and have an ambition to reduce our cost ratio by at least 20 basis points, 0.2% on average per year. And 0.2%, that sounds like an extremely small number, but given the size of Sampo, that actually adds 1% EPS growth per year. So if we achieve this over 3 years, over the next 3-year period, that will add 3% to our EPS. Now I talked about underwriting and growth and customers. A part of the business model of a P&C insurer is also doing investments, which we do. We obviously have reduced our market risk, reduced our Sampo's balance sheet and investment portfolio by exiting Nordea and by demerging Mandatum. Both those two parts of the group represented a significant part of the market risk or investment risk that we carried 3-4 years ago. Investments are still important for us. We have a portfolio of 15-16 billion euros, but it's not the main driver for profit growth going forward. But it will, of course, add to the operating result and dividend-paying capacity of the group in terms of nominal amounts. We've been able to take advantage of the higher interest rates that we have seen by extending our duration and reducing credit risk. When rates are higher, it actually makes sense for us to take a little less risk. We also have an allocation to equities. You see here just shy of 10%, because part of our balance sheet, part of our liabilities have a very long duration. Means that it's a long time from we get premiums until we pay final claims, just because of the way the products are structured, which also means that we can take some equity risk. Fundamentally, we are a long-term investor that want to achieve good, attractive absolute returns. And we've been able to do that. If you see on the right-hand slide or right-hand side of this slide, we have generated an investment return of about 290 basis points above the risk-free rates for the last 14, 15 years. That is equivalent to about 300 million euros on average per year in overperformance compared to the risk-free rate. So that was investments. Now I'm going to jump a little to the balance sheet of the group, where we have a new solvency target of 150 to 119%, which is a reduction in the midpoint of that range of 10 percentage points. Solvency can be complex to understand the details of, but the fact that we have been comfortable in reducing the midpoint of our target range is a result of the fact that we carry less risk. Our balance sheet is more predictable, stable than when we had the previous range. We kept our below financial leverage target unchanged at below 30%. We have a comfortable leverage position, but don't see any reasons to materially increase our total debt on the balance sheet, which again means that we keep the financial leverage target unchanged. To support the EPS growth and obviously also support our capabilities to return capital to shareholders and add to the regular dividend, which we expect to be stable, at least stable year over year. And we have a history of growing it in line with our underwriting profit growth. To add to the EPS growth, we have some capital management actions which are outlined on this slide. I already talked about the reduction in the midpoint of the solvency range, which releases some capital because we can operate with slightly lower buffers. And then we also have a process with the Swedish FSA to have a so-called partial internal model to calculate our regular solvency capital requirement with. The partial internal model basically represents better the diversification we have in our P&C business. So it gives a better way of accurately calculating the solvency capital requirement. These two things, technical things combined, we expect will generate about up to 700 million euros of so-called deployable capital. Then two things which we haven't done yet as a part of transforming Sampo into a pure play P&C group is to sell Sampo PLC stakes in Nexi and Noba. These are two assets we own through private equity companies. So we are not in charge of these assets or make decisions of when these private equity companies will exit these assets. But we added them over the next 3 years to our capital optimization actions, which will, on top of the 700 million, add about 500 million euros if we use the balance sheet value we have today. So 700 plus 500 is capital generation of 1.2 billion euros over the next 3 years, which will add to the profit that we are making in terms of how much capital we will have to deploy. When making Sampo's balance sheet more efficient and reduce the need for capital and capital consumption, it also increases the return, everything else equal, on the capital that we have on our balance sheet. You see here that we increased our return on so-called own funds, solvency equity capital, from 12 to 16% over the last 3 years. And with the capital management actions I just went through, that will add an additional 5% when using the profit we had last year to the remaining capital base after the things mentioned on the left-hand side of this slide. So a significant increase in the return that we generate on our capital, as illustrated to the right-hand side of the slide. I'm not going to go through the more than 4 billion again, but just in terms of how to spend the capital we generate, we have one clear first key priorities, and I mentioned it already. It is the regular dividend that we pay. The regular dividend, which was 1.6 euros, as the board has proposed to the AGM, and then we had an extra dividend, which is a part of the proposal, of 0.20 on top of the regular dividend. The regular dividend is going to continue to be important to us also going forward, and over the last 2 years, it's grown in line with the stable underwriting profit growth. Excess capital that we generate on top of the regular dividend can be used either as bolt-ons or as additional capital return, either in form of extra dividend or buybacks. Given the fact that we're not going to have the same situation as we had when we sold Nordea shares, when we had significant amount of excess capital all the time, we expect to review our excess capital position every 12 months or so going forward. But we will already give an update on the current excess capital position with the Q1 or Q2 result, once the board has a refreshed buyback mandate from the AGM and this partial internal model application process with the Swedish FSA is completed. This is just a illustration in terms of numbers of what I really already have talked about. The regular dividend, the stability and predictability of the regular dividend, and the growth trajectory that we've had in that part of our capital return over the last strategic period. And as you see, we have on top of the regular dividend also done buybacks and extra dividend. Both those tools were absolutely necessary when we had the situation we had when we sold Nordea shares, because we had so massive amounts of excess capital. Now that the situation is going to be more incremental, but still positive, it is, of course, a bit easier for us to also use buybacks as a tool to complement the regular dividend going forward. So, I think this is the last slide of my presentation, and conclude just on the targets. We have a really good competitive position going into this strategic period and have a target to grow our operating EPS by more than 7%. Not 7%, 7.0, but more than 7%. Then we have even better margins in our business than we had 3 years ago. So we have reduced our combined ratio target to have discipline in our growth and target a combined ratio of below 85%. The third target that we set was this deployable capital generation of more than 4 billion euros, which will be generated by delivering on our EPS growth targets and the capital management actions that we are busy working on. This will secure a clear ability to continue to pay a stable regular dividend that grows in line with the operating result, and also give us flexibility to add to that capital return when we have excess capital. A company, for you as an investor, to think about Sampo and P&C insurance can sometimes be complex because it is insurance. But to think about Sampo, you should think about Sampo as a company which is large scale, which has the scale to invest in customer satisfaction, the scale to invest in the future without deteriorating the cost efficiency of the company, and also a company which have diversification, which means that the stability and predictability of our result, which our track record show, is very high. Thank you for listening.